This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. The dollar surges in early Asian trading with stocks primed for losses after President Trump carries out his threat of 25% tariffs on Canada and Mexico and 10% on Chinese goods. Investors bracing for a trade war with cars, clothing, food and liquor all in the firing line. Canada already set to slap 25% levies over $100 billion of US goods. Plus, Beijing vowing what it calls corresponding countermeasures, with the yuan and Chinese stocks listed in Hong Kong set to face pressure today.
Markets bracing for volatility as we've seen those tariffs coming from President Trump. We're seeing U.S. futures to the downside of more than 2% for the Nasdaq 100 as we are continuing to reel from volatility already from Chinese AI startup DeepSeek. So we're watching those tech stocks, but also take a look at oil just jumping more than 3% at the open. We had already seen some upside given, of course, the tariffs will include Canadian oil, 10%, almost all of Canada's 4 million barrels flowing south into the United States. That's expected to really raise the prices for Americans. But take a look at the dollar because we had already seen the best week since November, only around 1% below January's more than 2-year high. If you flip the board, you can see those currencies because we also have the Mexican peso, which fell by more than 2% at the open against the U.S. dollar. The Mexican president already talking about a plan B to defend against tariffs on Monday. We're seeing the offshore yuan also falling to that 736 level against the U.S. dollar. We're talking about really the lowest on record almost. We're getting almost to that point right now. The Canadian dollar already at a 2-decade low. Take a look at how we're setting up for the Asian market opens as well, because we'll be watching, of course, Korean stocks as well. The South Korean December industrial output rising more than expected, 4.6% month on month. That was just breaking right now. The estimate was for barely a gain. We'll be watching those semiconductor makers with exposure to China like Samsung, TSMC, Morgan Stanley saying that Taiwan and Korea are the most exposed in terms of tariffs to the United States. You can see the reaction right there with futures on the Nikkei falling 1.8% as well, Heidi.
Shery, the frenetic pace of these headlines and the trade developments warrants a closer look. So let's take a look at all of this and the impact across the global economy as well as global markets. Our global economics correspondent, Enda Curran, is in Washington for us. Also, our chief North Asia correspondent, David Engel, in Hong Kong. Garfield Reynolds, who leads our markets live coverage, is also with us here in Sydney. Enda, let me start off with you. And we know that it's going to take some time when it comes to seeing really the global and perhaps regional impact of these tit-for-tat tariffs. But what's the expectation here?
The expectation is, Heidi, these are now very real. The breadth of the tariffs go beyond anything that happened in Trade War I. The initial focus really is on the Canada-Mexico fallout, 25% on goods, right across the board from the consumer basket, vegetables, food, clothing, of course, through to cars and car parts. Within that, then, of course, you have the energy mix coming out of Canada. The tariff on oil from Canada has been set at 10%, so some relief there, but a mix of inflation impact and growth impact for all countries involved. The Canada-China story kind of overshadowing the Canada-Mexico story is overshadowing the tariff on China of 10%, but that is across the board and all goods coming in. It also includes the de minimis trade of goods coming in underneath that $800 threshold. So significant moves. Economists say will have a reasonable impact on the economy, but of course it will take time just to see how this does play out in full.
Steve, we're still waiting for China's pledged corresponding countermeasures. They have a lot of tools that they could use at this point.
They do and they don't as well, because the imbalance in trade, obviously. There could be some other measures coming from Beijing. We've had so far a fairly muted response from Beijing. It is still, wrapping up the Lunar New Year holiday. The markets don't really start getting in full swing until midweek in China. Xi Jinping has not necessarily commented directly on this that we know of, but Commerce Ministry has. They've expressed the strong dissatisfaction and also vowed corresponding countermeasures, as you rightfully said. They didn't elaborate what those measures might be. They've also pledged to file a complaint at the WTO citing serious violation of international trade rules. But, you know, beyond tit-for-tat retaliation on tariffs, they could expand their export controls on critical minerals. They could restrict market access to some American companies. They could do something with the renminbi, obviously, to cushion the blow on exporters. And that's why we'll be watching the daily fixing later this morning, as we rightfully said at the top of the hour, the offshore yuan approaching that record low right now, you know, around 7.3. So a number of things they can do, but keep in mind there could be some benefit here for exporters in China if Trump is going after on a larger scale, as Enda just mentioned, with Canada and Mexico, and vowing to go tough on the EU on the trade front. That could open up export opportunities to those markets for China. So, you know, this is still early days. You know, Enda mentioned about the de minimis, you know, target on exports of lower value e-commerce to the United States. That's one step. There could be further export tariffs from China to the United States, upwards of 60%. He's also vowing to further increase those tariffs if there are retaliatory measures from the countries targeted, including China. So we're just in early days here.
Early days, as Steve says, and yet so much has already happened. What are we expecting from how traders want to trade this? Because for a long time, they've been pretty sanguine about the trade war risk.
Well, it's interesting, Heidi. There was a lot of concern about the trade war risk going into the inauguration, pegged on Trump's pledges on the campaign trail to sign tariffs from day one. When he didn't sign them on day one, people sort of thought, OK, we've called his bluff. You know, he's not that serious about this. He's serious about, you know, what he wants to do with the border and cutting government staffing or expenditure levels and some of the other things like going after DEI programs. But he's not so serious about tariffs. What do you know? He was serious about tariffs. He was just taking a little bit of time to get to them. So that's exacerbated the shocks that have come out. You know, we've seen the big moves in markets this morning. You know, even going into the end of last week, when he was signaling pretty strongly they were coming, there was still, you know, some reports that the actual tariffs might not come until March. There was also the potentially false lead from what went on with Colombia, where you know, he imposed tariffs, then took them off soon after, because Colombia, you know, gave in and accepted the planes. Problem is, there are no planes here, as it were, for Canada and Mexico to accept. And also from their point of view, there's a definite sense of outrage that these two countries, who have been long-term US allies, are being punished for what they see as, you know, as being incorrect. We had Scheinbaum out earlier today making the point that, you know, Mexico denies very strongly and is offended by Trump's, you know, assertion that they're tied to the drug cartels. So with that sort of rhetoric going on, it becomes much harder to see how there's some sort of compromise that gets achieved. Trump's language has not sounded particularly interested in compromise. I think part of what's helping to drive the moves is, you know, his comments that, you know, this is there will be some pain, or there may be some pain, but we need to move ahead doing this. So traders, to some extent, are taking him more at his word than they were a couple of weeks ago.
And could this just be the start, given that President Trump has mentioned 60% tariffs on Chinese goods at one point? And what would be the subsequent economic fallout for the U.S., which, of course, already faces potentially higher energy prices?
Yeah, President Trump has been clear in his views on tariffs and on closing down trade deficits. A bit like Garfield mentioned, the complication with this Canada and Mexico story is that he has linked tariffs to imports of drugs, and of course illegal immigration. So we need to see whether or not Canada and Mexico can reach some kind of terms with the president on that. But then, to your point, of course, we also know there's the USMCA, there's a trade agreement between Mexico and Canada coming up for talks next year. There's a view that this really is the start of a long renegotiation of that agreement. And then throw into the mix defence spending is also getting mentioned, particularly for Canada and NATO. So there's a lot going on here, but that's Canada and Mexico. Then, to your point, we turn to Europe. Similar complaints. The president made clear tariffs will be coming. He's mentioned aluminium and steel, unfair treatment in his view from Europe. And then, of course, you get the whole China story. Now, the president is clear that he believes this will drive investment at home. It will raise revenues for the government, and it will balance trade books with the rest of the world. But, economists on the ground are cautioning that for Mexico, it will slow down their industrial side market materially and, of course, hurt their farming sector, maybe even create a recession there, hurt Canada's economy in a similar way. And for the US, the warning is that tariffs as high as 25% on consumer goods will be passed on to Main Street. That will drive up prices, at least in the near term. Then, of course, you get into question marks over business sentiment, business confidence, where do they invest, what happens to their supply chains, and the rest. But it is, early stages in terms of how this plays out. But right now it's moving pretty fast. And I think a 25% tariff on all goods coming in from these trading partners on either side of the border is considered to be a big deal for the economy.
Steve, as you alluded to earlier, perhaps Beijing has fewer tools given that its economy at this point is under a lot more pressure than back in 2018, right? So what do we see as being the domestic economic impact? And I guess also what can Beijing potentially do given that Trump has said, he's potentially willing to unwind some of these measures if his grievances on fentanyl, et cetera, are perhaps alleviated?
Yeah, I mean, clearly the Chinese economy is struggling to gain footing of its own making, largely because its export situation has kind of supported the economy at a time when the property sector is still trying to find its footing, and of course consumer confidence is so weak. So yes, these tariffs are going to hit the Chinese economy, but I think initially it's going to be fairly muted because there's been a lot of front loading of orders, from the United States of Chinese goods. But, longer term, I saw the Bloomberg Intelligence from Changshu report about saying that this could shave as much as 0.9% off China's GDP at the worst case scenario with these 10% tariffs. It could slice as much as 40% off China's exports to the United States. But again, still so much is in flux right now. And again, on the fentanyl issue, Xi Jinping could potentially do, some strong measures and cut it off, obviously. But they have to somewhat acknowledge that they are sending the precursors, allegedly, to what Trump administration has said are the drug cartels in Mexico. Yes, the Biden administration, or Biden himself and Xi in San Francisco, they both vowed to tackle this issue. Xi promising to tackle it on the domestic front in China, but they have to also admit, perhaps internally or across the hotlines to the Trump administration, that they can do something. He has the power to do that. We talked about the de minimis exemptions as well of $800 packages to the United States that has fostered e-commerce like Temu and Shine and Alibaba and the like. But the Trump administration has been saying that some of these fentanyl precursors have been coming that way into the United States because it has not necessarily gotten customs, scrutiny, just notification. So that's another way that the United States is potentially cracking down on small packages but mass quantities, allegedly, of the precursors to fentanyl.
And Garth, we haven't to this point really seen the ability for Chinese risk assets to respond yet, right? How much pressure could we see on the yuan and I guess broader stocks, given we've already seen a bear market for?
Yeah, well, I mean, the yuan can cop plenty of pressure, partly precisely because the PBOC has acted to restrain, those declines. Also, of course, the yuan did bounce back quite strongly in that initial, Trump isn't immediately imposing 60% tariffs on China response. So there's that angle. As for equities, they're definitely in danger of fresh declines, especially in Hong Kong today. Chinese markets on the mainland are still closed for the New Year holiday, but Hong Kong opens today, and that's likely to be a fairly brutal open, to say the least.
Our Bloomberg Global Economy correspondent Enda Curran is with us there, along with our Chief North Asia correspondent Stephen Engle and Garfield Reynolds, of course, who leads our Markets Live Asia coverage. We'll have ongoing analysis when it comes to the Trump tariff impact with the Hinrich Foundation. Later, we'll also be getting Sakana AI's outlook when it comes to Japan's artificial intelligence landscape, and Schultze Asset Management will be coming along with us to tell us why they think we're actually entering into one of the most opportune times for investing.
Plus, India's budget delivers a $12 billion tax cut in a bid to boost consumption and investment. Details just ahead. This is Bloomberg.
If we have tit-for-tat retaliation, whether it's 25%, tariff 60%.
All we know for sure is that it will have a global negative impact.
In the US, you put on tariffs, these things can be inflationary.
The tariffs is not really the tool to deal with economic security consideration.
It's far more complicated than it's this way or this way. It's inflationary or deflationary.
The only thing I can say, there are losers on both sides.
There could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments.
We're going to see double-digit global GDP losses. Double-digit. That's catastrophic. Everyone will pay. Everyone.
Economic leaders from around the world discussing the global impact of tariffs and trade wars, and take a look at the setup. And as we were talking about earlier, we sort of going into the inauguration did see quite a bit of concern over these incoming tariffs, and then that was sort of followed by a period of fairly sanguine trading. At the moment, though, we're not seeing that calm, really. We're seeing that haven demand going into the dollar, the US dollar just surging in early Asian trading. Stocks, though, broadly set to decline, particularly as we have Hong Kong was getting that first reaction once we see that reopen, given that we have had a few sessions of really sort of missing out on that catch down, if you were. We're also looking at oil pretty closely surging there. We're seeing New York traded crude just shy about 2.5% to the upside as we see President Trump's tariffs on imports, including crude from Canada, really sparking pledges to see retaliation, raising more concerns about disruption, not just to global trade, but also global energy markets at a time when we continue to deal with ongoing Middle East uncertainty as well. So we're seeing that big move when it comes to crude energy from Canada, which ships almost all of its 4 million barrels or so of daily crude to its southern neighbour, facing that reduced levy of 10%. Let's get some more perspectives when it comes to these broad trade tensions with Hui, who's the Senior Trade Policy Analyst at the Hinrich Foundation. They're an Asia-based organisation working to advance mutually beneficial and sustainable global trade. Hui, really great to have you with us. So, President Trump said he was doing this as he was being elected. He's now putting in place these measures. What do you see as being kind of the short-term, medium-term and potentially longer-term impact of this on global and regional trade?
I think in the short term, I think impact of the tariffs would be more muted, because I think companies would already have stockpiles ready. But in the medium to longer term, I think impact would be particularly large because of the shifts in supply chains as companies seek to diversify their markets and look for new opportunities elsewhere. I think there would be some opportunities for other economies that are not hit by the Trump's tariffs to position themselves as alternative suppliers or more reliable trade partners in order to attract more investments.
When it comes to the biggest losers and winners and the sort of pass-through impact, do you see the US consumer as being one of those biggest losers? How impacted really do you see the likes of the Chinese economy, for example, or the Canadian or Mexican economies?
So certainly, I do believe that the U.S. Consumers would be one of the biggest losers, along with U.S. businesses that relies on imported goods. Comparing the impact on Canada, Mexico, and China, I think the impact would be more significant, especially on Canada and Mexico, because of their deep reliance on the U.S. as a very important export market. So relatively for China, their supply chains and the export partners are more diversified. So having faced a lot of disruptions from previous Trump tariffs and Biden tariffs, I think China's impact on China would be relatively less compared to Canada and Mexico.
Yeah, I was going to say, I mean, this is not the first time that we're seeing these tariffs against these countries. We have had Trump 1.0 already, right? So how much of that readjustment has already taken place and how much more needs to take place?
Yes, certainly. In the first Trump administration, there has been a tariff war raised on China, and along with Biden administration, the tariffs have been raised for certain Chinese products like EVs, solar panels, etc. So I think that there is a limited impact there on China because of the a lot of tariffs have already been. China has already been hit by a lot of tariffs, and because supply chains have already diversified from China to move into third countries, particularly Mexico and Vietnam, especially.
So, Jiahui, how legal are these tariffs imposed by President Trump, and could we see more challenges in the courts coming from businesses, for example, that will be targeted? What do we see in the first administration of Donald Trump that could help us understand how this might unfold?
So these are unilateral tariffs, definitely not encouraged by international trade rules. But I think that under Trump, I think we can expect that his promises to impose tariffs will hold true. I think it will be particularly challenging given that he has promised to impose tariffs, especially on all other countries, to hit them with a 10% tariffs.
Jiahui T, Senior Trade Policy Analyst at Hinrich Foundation. They're trying to really understand how these tariffs coming from President Trump will really unfold and affect global trade. As we're getting the latest comments again from President Trump right now on Truth Social about South Africa, saying that funding to South Africa will be cut until full investigation is done. He's accusing South Africa of confiscating land and treating people badly, so they will be cutting off all future funding to the country. We are now seeing the market impact of that with the South African rand extending losses to about 1.5% plus, as Trump now is announcing on Truth Social that South Africa has treated people very badly and they're stopping funding to the country. Haidi.
Some of the other stories we're following, Shery, this hour, and the U.S. Secretary of State has told Panamanian leaders that Washington will protect its rights under the Panama Canal Treaty if Chinese-connected companies continue to operate near the waterway. Marco Rubio says China's influence in the region represents a violation of the treaty, calling the status quo unacceptable. Panamanian President Jose Raul Mulino says he does not sense any real threat to that treaty. The USAID website went offline over the weekend as the Trump administration reviews its future. Sources say some officials there were also placed on leave after denying staff from Elon Musk's Department of Government Efficiency access to systems, citing lack of security clearances. This follows a President Trump executive order to halt and reevaluate US foreign aid. The European Union has said that it will respond firmly if the US imposes tariffs on the bloc. President Trump on Friday said he would absolutely impose tariffs on the EU. The European Commission will discuss the issue during a meeting in Warsaw on Tuesday, although it says it's not aware of any specific additional tariff plans. Trump's tariffs against Canada and Mexico are threatening production at automakers across North America. The duties are expected to hit immediately almost 1/4 of the 16 million vehicles that are sold within the US each year. Wolf Research analysts estimate it could raise the average price of a new car by about $3,000, Shery.
Heidi, take a look at how U.S. futures are trading at the moment. We are seeing downside pressure, especially in the NASDAQ 100, which is losing about 2.4%. This, of course, as we are still digesting those tariffs imposed on China, Mexico, and Canada that take effect Tuesday, 12:01 p.m. The dollar already has seen its best week since November, and we're continuing to push higher on those safe haven flows. Only around 1% below January's more than 2-year high, so we'll be watching that closely as we're seeing the downside pressure on Asian currencies at the moment, as well as Mexican and Canadian dollar, given, of course, the tariffs on those economies. We have more ahead on the Asia trade. This is Bloomberg.
Tonight, I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time, to allow Canadian companies and supply chains to seek to find alternatives.
Canadian Prime Minister Justin Trudeau there, as we're seeing the CAD trading at around a 2-decade low against the U.S. dollar already. The China Show co-anchor David Ingles joins us now for the market impact of the tariffs. And David, it could be a bloodbath today in Asian trading.
Well, it is already. In fact, just the early going share, as you point out. In fact, I'm just looking at multiple screens up. It just takes this much to really go cross-asset at this point in time. And I'll start off with the Canadian dollar because you pointed out. In fact, it was just on Thursday, I believe, when we were in shows here. In fact, no, it was as recent as Friday that at that point in time, we were looking at two specific levels on the loonie, right? One was the low that we hit during the pandemic. And before that were levels in 2016. You know, just one quick swipe, and we've taken out those two levels. And as you point out, we're back to the lowest since 2003. I'll make it very simple as far as the FX markets go, right? Everything is down except the dollar, which is down against the Japanese currency, which I guess in many ways underscores the risk aversion that's out there. The other thing I want to point out, though, as we go into the Japanese Open, where you are, Shery, is, you know, keep in mind, Japan actually closed higher the last time it traded. And, you know, we don't usually, you know, throw out the, you know, the word gap lower, you know, that liberally here. But when you look at what's happened in U.S. futures, for example, significant gap lower, we're down about 2% on those contracts. The contract traded over in Japan, there's one in Chicago as well, are showing some substantial downside right now. So the one that's actually traded, we're down about 900 points here. About 2.2% on the contract that's actually traded over in Singapore. So do expect Japanese markets to come off, I would say, about 1.5%, and that's being kind as far as that's concerned. The other thing I want to point out before we talk about the other markets that are coming back online today, because those have other plot lines involved too, is that apart from risk assets pulling back almost just about across the board, it's very early, so liquidity is quite thin. The other ones that are moving actually against the grain are inflation proxies, right? So you have Treasury futures actually doing, if cash markets were trading at this point in time, yields would be higher as well. And our guys at Bloomberg Economics actually think this will be inflationary, and they put out some projections to that effect, because they do see a significant supply shock to the U.S. economy, given that this does cover 43% of U.S. imports if you base the covered markets based on 2023 trade data. Back to you guys.
Dave, we could see sort of quite the post-Lunar New Year reopening as we get that first reaction from Hong Kong stocks, Taiwan as well, and also, of course, how much pressure the yuan could come under.
Yeah, and that's interesting because the yuan is in fact already trading, and I have to caveat this, the offshore renminbi is actually trading very close to record lows, and the fact that mainland markets will remain shut today does make it a bit trickier because you don't have the fix, you don't have the fix for the day, which tends to act as an anchor. There might be other ways, of course, that we could see. I don't want to use the word intervention, but I just did right now. Essentially, markets trying to maybe grasp where authorities don't want to see the currency trading. The other thing I'll point out is when you look at the Hang Seng, you have two major themes colliding here, right? You have this risk aversion that we're seeing right now. The opposite, though, is the AI trade that's actually bid up substantially. A lot of the AI plays in China that, while China and Hong Kong were sleeping, in the U.S., so Alibaba and the likes of Baidu, for example, are actually trading at slightly higher levels than the cash market close here in this side of the world. Watch that closely. And I'll end on this. Taiwan is also one market that opens up in about 90 minutes or so. Just close your eyes when that market opens up, right? So that's going to play a massive catch down because of the AI trade and the risk aversion that we're seeing out there as well. So I'm barely awake. I haven't had my coffee yet. I only have one cufflink on. I barely had time to put the other one on, but yeah, I'm going to rush back to my desk and get ready for the show. But yeah, you guys hold the fort.
Welcome to the next 4 years, David.
You need another cufflink and another few coffees, for sure. David Inglis, our China show co-anchor, will let him go and prepare for what could be a pretty big day for Greater China markets. And, of course, we're seeing another big story set to move the markets today a little bit later on. India giving its middle-class consumers $11.5 billion in tax relief in its latest budget, in a bid to shore up its economy amid growing global risks. But there was little direct support for millions of unemployed. Let's bring Bloomberg's economy reporter, Swati Pandey, who's here with more. So what's been kind of the assessment of the budget that was delivered over the weekend?
If you look at stock market reaction, it was a bit muted, not very impressed. In fact, Modi supporters have called it B for bold, B for brilliant. The opposition leader, Rahul Gandhi, has called it a B for Band-Aid budget for bullet wounds. India's economy is slowing sharply. It's the slowest, going to be the slowest year since the pandemic in the year ending March. Wage growth is negative. Unemployment, in particular youth unemployment, is a problem, and it looks like this budget does not address any of those problems in a meaningful way. And also lacking is a vision to make India competitive on a global scale and to boost economic growth the way that China grew in the 90s.
So at this point, who do we think are the winners and losers from this budget?
So from the tax cuts, the biggest beneficiaries would be the consumer goods companies. Discretionary spending is expected to pick up. It's really weak at the moment. And that is precisely why the government did this. The other winner, I would say, is the insurance sector. The foreign direct investment limit has been increased to 100% to bring in more capital and more players into the sector. That will also probably be a little bit of a boost to the healthcare sector. And if I have to pick losers, one of the losers is infrastructure spending. And we saw that in share market reaction in construction firms and cement companies as well. The government is not spending a lot more on infrastructure. They are trying to focus on fiscal consolidation, reduce their debt to GDP ratio. And the other big loser, I would say, is India's youth. India is not yet tapping its demographic dividend. There's not a lot of spending on education. There's not a lot of spending on healthcare. And that is what is needed to pull India out of this youth unemployment problem that it is right now in.
And of course, all of this is made, these decisions being made within an environment of growing trade uncertainty, right, and risk. Are we seeing some policies that are sort of targeted towards buffering for that?
There is a bit of some measures that have been taken to boost domestic manufacturing. There was import duties that were announced to help companies who are diversifying from China to set up investments in India. But in terms of broader policies, we have still not heard a lot. India is definitely trying to avoid big U.S. tariffs from U.S. And it will try and meet somewhere midway with Donald Trump and try and see how India can avoid the fate that Canada and Mexico and China have met.
Our Bloomberg economy reporter Haidi Pandey there with a look at the weekend's budget, and we'll have more analysis on that later today. Anand, Rathi, Wealth's Shweta, Rajani, and the former HDFC Vice Chairman Keki Mistry will join us live from our brand new studio in Mumbai. We'll also be getting insights from India's Chief Economic Advisor, as well as Morgan Stanley. More ahead on the Asia trade. This is Bloomberg.
It's time for Japan Ahead, and we're watching Japan's moves in response to the Trump tariffs on some of its trading partners. The Nikkei now reporting that Prime Minister Shigeru Ishiba will ask the U.S. president to visit Japan this year. The government has also started a consulting service for firms that will be hit by the trade war. Ishiba is also set to meet today with OpenAI CEO Sam Altman and SoftBank CEO Masayoshi Son. And hearings are due to begin later Monday in the U.S. on Nippon Steel's last-ditch lawsuit to save its planned merger with U.S. Steel. And Nippon Steel is among the big names reporting results this week. Its net income may be dragged down by lower revenue across most segments. In the auto space, Toyota's third-quarter earnings may fall from a record after production was hurt by a testing scandal. And Japan's big banks look poised to reap the rewards of last month's BOJ rate hike. A buoyant domestic stock market could also boost earnings for Mizuho and MUFG. SMFG already reporting last week that it's on track for record annual profits. Take a look at the setup for Japanese markets right now, because we're seeing some downside pressure for the Japanese yen at this moment after gaining ground in the previous session. But of course, we do have a resurgent U.S. dollar on that safe haven move from tariffs imposed on China, Mexico, and Canada. Nikkei futures pointing to the downside of more than 2% after 3 sessions of gains already last week. We have seen already volatility in the tech sector, given China's DeepSeek challenging that AI enthusiasm that we've seen really over the world, especially when it comes to some of those Japanese stocks like SoftBank as well. We had already BOJ commentary coming from Governor Ueda, really thinking that the markets have clearly received what they want to do in terms of rate hikes. We are going to get the BOJ minutes in about 7 minutes time or so. And as we mentioned earlier, the OpenAI CEO Sam Altman is due in Japan on the first stop of an international tour. He'll be looking to reassure key partners about his company's technology as the emergence of China's DeepSeek rattles AI developers and investors. Altman's due for talks today with Prime Minister Ishiba and his partner in the Stargate U.S. AI plan, SoftBank CEO Masayoshi Son. Let's take a closer look at Japan's innovations in the sector. Sakana AI has recently released 2 new models, Transformer Squared and Tiny Swallow, aimed at making AI adaptive and efficient. Joining us now in Tokyo is David Ha, co-founder and CEO of Sakana AI. Great to have you back, especially when it comes to being in the Tokyo studio.
Thanks for having me on, Shery.
Let's talk a little bit about the models that you've released, because it's been interesting how people have been focused on spending a lot of money for AI, but what you're trying to do is making AI work more efficiently.
That's correct. I'll give you a bit of a context of our R&D. In the past few years, the narrative that has been established is that we need to build bigger models that consume more energy, hence require greater sums of investments in order to have a winner. But I think for the companies such as Sakana AI and many companies like us, we strive to make technologies that make this AI technology 1 million times faster and more efficient. And I think this is what's needed for the technology to move forward.
Tiny Swallow, for example, is one of those projects that you're putting into actual local devices?
Exactly. So Tiny Swallow came out of a technology called a TADE, which is a new model distillation method. This method allows us to train a very small model that is typically like 1/100th the size of a very large model, where the model can actually maintain most of its performance. And as a proof of concept, we've shown that the model we trained on Japanese data, Tiny Swallow, works entirely inside of a smartphone or entirely inside your web browser without it calling an API. And we see this new type of model distillation development as a key trend in 2025 for foundation models.
What do you make of the volatility that we saw around Chinese startup DeepSeek and its way of trying to set these AI skills to be cheaper and more efficient?
Again, I think this is also the trend that we're going to see in the next few years. The traditional players in the West have been trying to scale up the models, get larger investments, and perhaps that may be the only winner. That's the established narrative. But with companies like DeepSeek and ourselves, I think for the technology to move forward, we need this technology to be 1,000 times or 1,000,000 times faster. The analogy I have is the current large language models or AI is kind of like the mainframes of our generation. How, at the beginning, you need this large investments to build the mainframe, but ultimately, the technologies that actually, everyone uses in 5 to 10 years are like the highly optimized versions, like the PCs markets and the smartphone versions of these mainframes. And, I think, we're going to continue to see many more efficient models around the world, not just in China, hopefully from Japan as well.
Can you tell us more about the applications and how you see these smaller scale models being fed into the ultimate consumer? Because it sounds like you're saying, ultimately these smaller models are going to be perhaps more applicable on a real life day-to-day basis.
Well, sure. I think, right now in the last few years, the paradigm we have is you have a bunch of very large models that are served on an API across several vendors. But I think we're just getting started. As I mentioned to Shery earlier, I think the current LLMs are the mainframes of our generation. Future models, there will be many different models. Many will be derived from open source models, such as DeepSeek or Facebook's Llama's models or our own models. And I think organizations and individuals, everyone's going to use a variety of different AI models. I don't think everyone's going to be locked into a single vendor or, there will be particularly one single winner in AI, which seems to be the current narrative for the investors even.
Tell us about your partnership with NVIDIA. You've talked about teaming up with NVIDIA when it comes to research and access to data center technology and the such, and also your plans for further fundraising.
Great. NVIDIA is one of our key investors in our Series A. We have a great partnership with NVIDIA. We have a R&D collaboration. So we work together on leveraging our AI technology, in particular using AI for AI development itself, for scientific discovery, for AI discovery, for data center testing. As you know, in Japan, there are plans for large data center developments here. NVIDIA is a key player in that space, and we work closely with NVIDIA to develop the AI data centers here in terms of testing, in terms of deploying technology, and also to make AI more efficient for those data centers. Lastly is for community development. We work closely with NVIDIA to try to encourage a thriving AI ecosystem in Japan, so that this technology, this system, core technologies, is also developed in Japan, not just in the US or in China, for instance.
And just to reiterate Heidi's question, do you have any more plans for fundraising?
Well, I think fundraising is always an option for us, but I think right now we are actually in a very healthy state after our Series A. So we're actually focused on building the technology at the moment.
When you talked about NVIDIA earlier, for example, are there any concerns that we have seen their stock take a big hit, Magnificent Seven stocks take a big hit because of these cheaper models? Is it feasible to think that they could actually get more pressure if we see these, as you say, smaller versions of AIs working more efficiently?
Well, that's an interesting question. Well, I cannot predict the future, but I would say that even these more efficient models coming out of DeepSeek or Sakana AI or other companies, that's just going to increase the demand for GPUs and compute. It's just like the users of those compute will be different. I would say that there will be many more users around the world for DeepSeek models or Sakana AI models, and perhaps the demand side would coming from the inference side rather than the training side. But I would say that there's going to be more and more demand for compute. So I think NVIDIA is in a very good position to capture this increasing demand, especially from a global audience.
David, really good to have you with us, especially here joining us in our Tokyo studio, co-founder and CEO of Sakana AI. Catch Japan Ahead every Monday at 8:40 a.m. if you're watching here in Japan, and subscribers can watch live on the terminal using the TV Go function. We have much more ahead. This is Bloomberg. The Seoul High Court is set to announce its ruling after prosecutors again sought a 5-year prison term for Samsung chairman J.Y. Lee over a succession case. A lower court cleared Lee of all charges, including stock price manipulation and accounting fraud back in early 2024. Our Seoul Bureau editor Danny Thomas is following the latest developments. Danny, what do we know so far?
Hey, Shery. So as you said, Lee was cleared of all charges by a lower court, but then prosecutors decided to appeal that ruling, and the High Court is going to make its decision known at 2 p.m. local time. Now, there is some hope that because Lee was cleared of all the charges, because evidence was lacking the strength that is required, there is some expectation that the higher court will probably rule in favor as well. But that's just one of the expectations here. But if that happens, that will be a big kind of big support for Lee, because Samsung has been trailing its domestic rival HK Hynix, and this, if it goes away, this kind of thing that's been hanging over his head, then Samsung could be able to come back with a bit more of strength and focus on the business. So that's where things are poised now.
Procedurally, what are we expecting next? And as you sort of alluded to, what are we expecting as the broader impact when it comes to the leadership and strategy of the company?
So if the High Court goes again in favor of Lee, there is, in the widely, there is an expectation that the prosecutors may not go any further, because after 2 back-to-back setbacks, it's pretty unlikely that the Supreme Court, which is the other next step for either parties to go, may not entertain any more of these arguments. So a loss for prosecutors could mean that Samsung and Lee are off this case, and that means good news, because they can come back and focus on the core business, which has been kind of trailing here in the AI space especially.
Bloomberg News Seoul Bureau editor Danny Thomas there, as Samsung is one of the stocks that we're watching going into what, Shery, could be a pretty frenetic open here in Asia, Brad. We're already sort of seeing the reaction when it comes to the risk-off sentiment. Interestingly, of course, we still have mainland markets not being able to react, but we will see that reaction continue through the pressure on the yuan, as well as the reopening of trading in Hong Kong, where stocks, we know, Chinese-listed stocks in particular, are already under so much pressure. But also in Taiwan as well. So really, it'll be quite interesting to see how markets kind of take seriously not just the tariff threat, but now the reality.
Yeah, I mean, especially when it comes to Chinese stocks listed in Hong Kong, the tariffs include a broadside against Chinese e-commerce with plans to kill a tariff exemption for some packages. So we'll be watching those markets when they open. But really, around Japan, of course, we're also digesting the latest on the BOJ when they hiked rates to the highest in 17 years. One BOJ member now saying that it was appropriate for the Bank of Japan to raise the rate. We're getting those minutes from the summary of opinions at their last meeting. And they're also talking about upside price risks being higher. We'll be watching semiconductor names across South Korea with sales to China, including Samsung, of course. The market opens in Seoul and Tokyo. Are next. This is the Asia Trade. We're counting down to Asia's major market opens. But Haidi, should we better say we're bracing for the market reaction when it comes to the White House tariffs of 25% for Mexico and Canada, 10% on China. And of course, they will go into effect on Tuesday. Until then, we're seeing right now the yuan trading at record lows. The Japanese yen also reversing earlier gains as the dollar is now surging.
We're also seeing more pain across a broader emerging market complex, right? The impact on the rand. We saw a separate announcement from the Trump administration to cut off all funding to South Africa. There's a lot going on, but certainly today with the reopening in Hong Kong and Taiwan, we get a chance to see how those risk assets respond to the tariff threats and the tariff reality that was put in place over the weekend.
Yeah, we'll be watching broad sectors, especially the likes of semiconductor makers, because they have exposure to sales to China. Take a look at the Nikkei right now, opening downside 1.6% after 3 sessions of gains already last week. And the Topix is also losing more than 1%. The Japanese yen reversing those earlier gains to lose ground against the U.S. dollar. The U.S. dollar coming off its best week since November. Already, we had the BOJ minutes from their policy decision in January. The summary of opinions talking about upside risks to the economy. And also we had heard from Governor Ueda talking about how the markets have clearly received their message about tightening. But really today it will all be about the tariff reaction as we're still awaiting those corresponding countermeasures that Beijing has pledged at some point right now. Take a look at how the Kospi is also opening. We had industrial production numbers beating to the upside, but we've seen significant downside pressure already in this market. We have of course, the ongoing volatility around the tech sector, really the fallout from that Chinese startup DeepSeek and its impact on the AI enthusiasm. And we're already seeing the Kospi losing 2%. Semiconductor makers with exposure to China like Samsung. We're also watching those automakers with exposure to Mexico, for example, Kia Motors also. How they're trading in the auto sector will be key as the Korean won is weakening against the U.S. dollar by 1% at the moment, Heidi.
Yeah, we really are seeing that sort of broad-based reaction, right? Take a look at how stocks in Australia have been trading just over an hour in the cash session. We're seeing that plunge when it comes to the ASX at the moment, along with some weakness in the Aussie dollar. We're seeing the ASX 200 off by just about 1.9% off the session lows, but certainly we're seeing a great deal of weakness with financials, mining stocks weighing the most on the benchmark. And it makes sense given that we're seeing the likes of iron ore and copper really taking a knock as these global growth prospects take a hit from these increased tariffs and the expectations that that's going to pass through to not just global trade, but regional trade within Asia in particular. And as we remember, a lot of these Australian stocks and the Aussie dollar trading as a proxy for China risk and China weakness. We are waiting to see, of course, that reaction from Beijing. They're being perhaps a little bit more considered with their response than back in 2018 when we saw, a list of sort of countermeasures within just hours of the Trump administration releasing theirs. Shery.
Heidi, let's bring in George Schultze, founder and managing member at Schultze Asset Management. Great to have you with us, George, on this day as we're still digesting the tariff impact coming from the U.S. What are your expectations about where we will see the first fallout in terms of stock markets and also currencies?
Thanks. It's good to be back. So these tariffs, a lot's being said about them right now. You have 10% with China, 25% with Canada and Mexico. It's important to remember, though, that these are in place, according to President Trump, with his executive orders to penalize these three countries for allowing dangerous fentanyl into the United States. And so that's worth remembering because even though they're very broadly worded and they give U.S. Governmental personnel wide discretion in interpreting and determining the length of these tariffs for how long they stay in place, they're really designed to slow down the import of dangerous fentanyl into the United States. In fact, one of the executive orders specifically states that, importing this dangerous chemical is, crossing the U.S. borders is killing about 75,000 U.S. Citizens per year. So given that background, although of course the inflationary impact is concerning, and we don't know what's going to happen right now with retaliation. It looks like there'll be retaliation from probably all three countries, but it does sort of set the groundwork for a potential discussion about safety and restricting imports of this this terrible drug.
So tell us a little bit about that inflationary impact that you talk about and the potential market impact coming from recalculation of what the Fed could do.
Right. Yeah. So we're seeing a lot of concern about that. Most analysts are expecting a pretty big impact on the automotive sector for automotive parts. And then from coming up specifically from Mexico, agricultural commodities, I believe strawberries, avocados, things like that. And then, of course, into the construction market as well with the price of wood, because there's a fair amount of wood that gets imported, I believe, from Canada down into the United States for construction, specifically residential construction. And then, of course, electronics and also toys coming in from China. So, it has a broad impact, but it's designed to specifically protect U.S. citizens and, really protect lives. So we'll see how that sets the table for the negotiating, that's likely to happen over the next several days, weeks, and months.
It is not just the tariffs that are expected to have an inflationary impact within the US, right? There's also the immigration, the deportation agenda, as well as some of the tax measures as well. Are you more concerned about those in terms of elevating inflationary risks and the cost of living crisis?
I'm personally not that concerned about elevating inflation and concerns over that right now. In fact, we've been on a pretty steady decline in inflation over the last several years, ever since COVID. And, even though we haven't hit that 2% target yet with the Fed, certainly the Fed is continuing to tighten, and you have higher for longer interest rates right now. The bigger concern actually is if the Fed, maybe reduces the monthly rounds of quantitative tightening that they've been engaged in. So that's a, sort of a separate question. But overall, these Trump policies, and specifically I'm thinking also more, fiscal spending and a quick clamp down on governmental fiscal spending with a longer term plan with Department of Government Efficiency, or DOGE, to reduce spending, that hopefully that will help reduce the crowding out effect that we've been seeing from governmental spending in the U.S. economy anyway. And hopefully that will change inflation or have the opposite impact that these short-term tariff impacts will have.
When it comes to China, clearly the reopen might be a bit of a shocking one today, but everything that happened with DeepSeek, as sort of seismic a disruption it was for perhaps, expectations and what the thought is towards what these Chinese startups could achieve, does it make broader Chinese equities more compelling?
It's certainly worth looking at them. A number of them seem to be trading at very interesting valuations. There's still a lot of concern about what's happening with the Chinese real estate market and with the distress that we've seen there. But globally, on a comparative valuation basis, some of these Chinese companies look much cheaper than U.S. companies right now. Of course, you have other challenges with potential, political disruption and uncertainties with tariffs. But certainly it seems like, a pretty interesting alternative to the big cap or the mega cap U.S. equities that have rallied so much in the last several years.
George Schultze is a founder and managing member at the Schultze Asset Management there joining us. Let's get some more analysis when it comes to these tariffs with our Bloomberg News desk editor, Jill Desis. And Jill, these were promised, they were implemented and announced over the weekend. And it's quite interesting. We've seen that sort of flurry to respond from Mexico and Canada, but we're still waiting for Beijing's, corresponding countermeasures as they've promised.
Yes, that's right. And really, I don't know that we should be particularly surprised that we haven't heard a ton of details out of Beijing just yet. I mean, we did just see, and they're still sort of in the midst of celebrating the Lunar New Year holiday. Chinese markets onshore actually don't reopen for another couple of days. We're actually just getting Hong Kong back on today. But ultimately, I mean, that also kind of tracks with what we really saw out of Xi Jinping and out of Beijing during Trump's first administration, is that you see a little bit more of a muted reaction first. I mean, these tariffs, we did have a little bit of a preview to what we ultimately were expecting out of Donald Trump, this idea of this 10% tariff on some Chinese goods, in addition to obviously, the trade war that he really kicked off during his first administration here. But China also has a lot that they have to kind of grapple with, some concerns about the slowing economy more broadly, how exactly they maybe retaliate. So, again, not surprised the reaction is muted right now, but it may be that we get more out of Beijing sort of as the week goes on, as the next couple of weeks goes on, and they have a chance to sort of assess and decide exactly how they do want to respond here.
And we're already seeing the concrete reactions coming from other nations like Canada and Mexico.
Yes, that's right. And really, I think when it comes to Canada and Mexico, I mean, these 25% tariffs were telegraphed really in the middle of December, so before Trump even really came into office here. So you did have a sense back then of how exactly the Canadian and Mexican leaders were ultimately going to respond. We did get something more concrete from Canada over the weekend, saying that they were going to be targeting some U.S. alcohol with their own retaliatory tariffs of 25%. We'll kind of see exactly how that strategy unfolds, but obviously sort of bringing us into this idea that we've been talking about a trade war. Mexico also has sort of pledged retaliatory tariffs. So, I mean, we're still obviously waiting for these tariffs to go into effect. Have to kind of see how the machinations of all of this kind of come together. But yeah, I mean, it's obviously looking very serious here. You're seeing some of those retaliatory efforts kind of come into play here. And I think that's obviously, what's leading to a lot of these global market shocks that we're already digesting this morning.
Bloomberg News Desk editor Jill Deasy is there with the latest on President Trump's tariffs. Let's dig deeper into how China might retaliate and bring in our chief North Asia correspondent, Stephen Engel. Steve, this is really a conundrum for Beijing, right? How does it respond without hurting its own economy?
Well, that is one of the big questions, obviously, that is being debated within the ranks of the power structure in China. As Jill rightfully said, as they coming out of the Lunar New Year holiday. So the response so far has been fairly muted. We had the Commerce Ministry come out with some statements saying they strongly voiced dissatisfaction and viewed corresponding countermeasures without elaborating. They've also pledged to take the case to the World Trade Organization, debatable on how effective that might be given the unilateral approach from the United States. There's a number of different ways, I guess you could say, that China could respond. Sure, they could do their own retaliatory tariffs as well, but there's such an imbalance in trade going from China to the United States. That might have less of an impact. There could be further export controls on critical minerals, which China has monopolies on in many areas. They could also limit market access to some American companies. They could obviously, and we're already seeing the continued weakness on the renminbi, they could play with the fixing and allow the renminbi to depreciate. Offshore yuan expected to be hitting those record lows since obviously the offshore started trading in 2010. So that could help lessen the blow, obviously, for its exporters. But as far as retaliation, maybe they're taking a bit of a more muted approach right now, because you're absolutely right. Politically and domestically, Xi Jinping has to show some sort of defiance, if you will, some sort of retaliation, but they don't want to go too far to get into a tit-for-tat spiral that's going to damage China's own recovery efforts.
What can or will Beijing potentially do to respond to the allegations about China being the source of the fentanyl precursors? Do they even accept that China has a role of responsibility here?
Yeah, publicly they have not necessarily said that there is an onus of blame on China. We don't know exactly the dialogue between Biden and Xi in San Francisco, but the readouts from those talks were that they would work together and China would do what it could to limit the export, if that's even happening, publicly or acknowledged by China of the precursors for that drug to potentially, allegedly, the drug cartels in Mexico. But again, if you want to read the tea leaves, if you will, on China, pick up the Global Times today. Again, one of the mouthpieces of the Chinese government. They say on the fentanyl issue in particular, the U.S. fentanyl crisis lies fundamentally in its immense domestic demand in the United States, which leads to abuse and regulatory loopholes. And this is where China is going to probably continue to take the multilateral approach to this. They said addressing the fentanyl issue requires cooperation, not unilateral trade coercion. So that, at least from state media, is the perspective on fentanyl. Whether privately, Xi Jinping on the hotline to Donald Trump saying, okay, we can make a difference here and stop the alleged export of these precursors. But that's not something that's going to necessarily be announced publicly by the Chinese at this point. But there are things, Xi Jinping, if they are exporting fentanyl precursors, Xi Jinping has almost absolute control. He could make those moves if he needed to or saw a political expediency to do so in lessening the impact of these tariffs with Trump.
Our chief North Asian correspondent Stephen Engel, will be watching, of course, for those Chinese stocks as Hong Kong reopens for trade after the Lunar New Year holidays. Take a look at how Japanese car makers are trading at the moment. Big downside. We're talking about Nissan right now losing as much as 10% at one point, the most since the middle of December. Mazda also losing the most in 6 months or so. Many of the cars sold in the U.S. by these Japanese car makers are made in Mexico. We know that Honda Motor, for example, sends about 80% of its Mexican output to the U.S. market. We also know that Nissan Motor, of course, is trying to open a couple of plants in Mexico right now. So we'll be watching for broader fallout in the auto sector across Japan. We have more ahead on the Asia trade. This is Bloomberg.
Let's take a look at how we're trading as we are about 20 minutes into the start of trading in Japan and in Korea. Some firm downside there. The Nikkei 225 down by just about 2.5% to the tune of similar losses that we're seeing for the Kospi as well. And of course, we are seeing that downside being maintained for Australian stocks as a result of perhaps some of that China risk proxy playing out as well. We have seen that surge in the dollar as well as oil prices and that broad sort of risk appetite falling on these Trump tariffs on Canada, Mexico and China that were announced over the weekend. We are seeing President Trump there speaking there at the moment. Let's get some more analysis now from Bloomberg's global economics correspondent, Enda Curran, who joins us now from Washington. Of course, in many respects, these tariffs are unsurprising to anyone that's been following the rhetoric since, really since his the first Trump administration, right? But what do we see as sort of I guess the immediate and medium-term impact here, particularly as we do know something of the countermeasures that have been announced from Mexico and Canada already, waiting on that from China. But Enda, just hang on a moment. We are hearing from President Trump.
Allow that. And by the way, we have among the lowest numbers we've ever had of people crossing our border, the lowest numbers since my administration.
Mr. President, you said, so on Truth Social, you said that you were going to cut aid from South Africa. Will you plan to cut aid across other African nations, and why South Africa?
No, it's only South Africa. Terrible things are happening in South Africa. The leadership is doing some terrible things, horrible things. So that's under investigation right now. We'll make a determination. And until such time as we find out what South Africa is doing, they're taking away land, they're confiscating land, and actually they're doing things that are perhaps far worse than that.
And on the Fed Chair Jerome Powell, he held rates. What's your reaction to him not changing the rates?
What did you say?
Fed Chair Jerome Powell, the Fed meeting was this week, he held the rates. He didn't cut them.
No, I'm not surprised. I think holding the rates at this point was the right thing to do.
Mr. President, which country will be next on tariffs? Would you consider taxing the UK, for example?
Well, we're going to see what happens. It'll happen. But we're going to, we'll see how things work out. It might happen with them, but it will definitely happen with the European Union. I can tell you that, because they've really taken advantage of us. And, you know, we have over a $300 billion deficit. They don't take our cars. They don't take our farm products. They take almost nothing. And we take everything from them. Millions of cars, tremendous amounts of food and farm products. So the UK is way out of line, and we'll see. The UK, but European Union is really out of line. UK is out of line, but I'm sure that one, I think that one can be worked out. But the European Union it's an atrocity, what they've done.
Prime Minister Starmer wants a closer relationship with the EU. So
well, Prime Minister Starmer has been very nice. We've had a couple of meetings. We've had numerous phone calls. We're getting along very well. And we'll see whether or not we can balance out our budget. With the European Union, it's $350 billion deficit. So obviously something's going to take place there.
What's the timeline? And are you thinking along
Where?
the line 25%?
With who? With who?
The EU, how much?
I wouldn't say there's a timeline, but it's going to be pretty soon. No, I'm not going to say. We may have short-term a little pain, and people understand that. But long-term, the United States has been ripped off by virtually every country in the world. We have deficits with almost every country. Not every country, but almost. And we're going to change it. It's been unfair. That's why we owe $36 trillion. We have deficits with everybody. We help everybody. We've been helping everybody for years. And to be honest, I don't think they appreciate it. So we're going to change that. We're going to change it fast. We're going to make America great again. We have to focus on our country. We have tremendous potential if properly used, and we have to focus on our country. Tremendous deficits with China, tremendous deficits with the European Union, tremendous deficits with Mexico and Canada. And why? What's the purpose of that? Why would we have deficits? And yet you look at, if you look at pharmaceuticals and drugs, if you look at various products, it's much cheaper in other countries. We're not going to allow that much longer. We're not going to take it.
What's going on there?
Well, it's been run by a bunch of radical lunatics, and we're getting them out. USAID, run by radical lunatics, and we're getting them out, and then we'll make a decision.
Mr. President, have you spoken with anyone from Canada or from Mexico since you appointed?
I've spoken with people from Canada. I've spoken with people from Mexico, and I've spoken to a lot of other people too.
Prime Minister Trudeau or?
I'm speaking with Prime Minister Trudeau tomorrow morning, and I'm also speaking with Mexico tomorrow morning. And I don't expect anything very dramatic. We put tariffs on. They owe us a lot of money, and I'm sure they're going to pay.
Would you send troops to take the Canal of Panama?
About what?
Panama, the Canal of Panama. Would you send US troops?
I don't think troops will be necessary in Panama. What Panama has done is terrible for national security for this part of the world. And, 70% of the signage on the Panama Canal was written in Chinese. That's not right. So it wasn't meant for China. It should have never been made. The deal was a ridiculous deal. We lost 38,000 people building the Panama Canal, one of the great wonders of the world. 38, think of it, 38. It was the most expensive project ever built by this country, if you take it forward. The most expensive project ever built. We lost 38,000. And what happens? China owns it all of a sudden? It's not going to happen. We're not going to let that happen. We have national security concerns, and they wouldn't let it happen either.
Mr. President, what would Canada and Mexico need to do for you to lift the tariffs? What are specifically you want?
They'd have to balance out their trade, number one. that we've got to stop people from pouring into our country, and we've stopped it. They haven't stopped it. We've stopped it. They have to stop people from pouring in, and we have to stop fentanyl, and that includes China. Fentanyl has killed this year at least 200,000 people. It's pouring in from China through Mexico and Canada, and they've got to stop it. And if they don't stop it, the tariffs are going to get worse, a lot worse.
Mr. President, you're going to the border.
All right, that was President Trump there, just speaking at Joint Base Andrews in Maryland, touching upon really a wide range of topics, including these tariffs that he announced over the weekend on Canada and Mexico and China. He's promised tariffs to come when it comes to the European Union. He says they will definitely happen without giving an indication of the timeline there. He also spoke about, some of the other concerns when it comes to the fentanyl trade and how, of course, that has been tied in with the decision to put in place these tariffs, as well as commenting on the Chinese presence when it comes to the Panama Canal. He says that he'll be speaking with Canadian Prime Minister Trudeau tomorrow morning. And we have seen that reaction across markets. A pound extending the loss to 1% as these trade war concerns really mounting. Euro Stoxx 50 futures falling almost 3% there. We're seeing the Aussie dollar, often seen, of course, as a proxy of trade and China risk, now sitting at the lowest since April 2020 against the dollar. Let's bring back in Enda Kara now, global economics correspondent who joins us now from Washington. And, Enda, a lot to process there. One interesting thing I thought, he said that the Fed did the right thing by holding. So, it certainly draws a complicated picture for these central banks and policymakers amidst the start of yet another, trade war.
Well, it does. I mean, if you want to talk about the Fed angle on this, you have economists making the point that if you're putting duties on imports into the US, especially in the consumer space, then those prices will be passed along. We have some analysis out today saying a car could be $3,000 more expensive, for example. And then if you do have higher inflation off the back of these tariffs, then obviously that would complicate the story for the Fed bringing down interest rates. I think one of the interesting or one of the surprising observations people have had about the tariffs announced in Mexico and Canada and China is the breadth of them. There's no hint of a carve-out. It's not just input material or intermediate goods. It's food, especially food from Mexico. It's consumer goods. It's clothing. So obviously, it depends, of course, how much of the tariff is passed on by the importers. But nonetheless, it's clearly a talking point. The China tariff obviously is less. It's at 10% versus 25%. There's a case that that's maybe not as much as an immediate issue for the economy when you consider the exchange rate differentials there. But a lot of focus on what these tariffs might mean for growth and inflation. And of course, you just heard President Trump. He says it's all about balancing the trade books. It will drive investment and, of course, raise revenue for the government.
And what's interesting is that when it comes to the economic impact, of course, expectations are so important, right? Just talking about inflation could actually change consumer behavior. Are we starting to see this in terms of how Americans are pricing in the next few months, as we're now seeing tariffs on a broad series of goods, not to mention, of course, energy imports, which are so important for Americans?
Yeah, well, the energy imports are being tariffed at 10%, so there's some relief there. But, social media, for example, tonight, people are tweeting the prices of avocados going up in their local store. That's one of the imports that comes out of Mexico. And, of course, the critics of this tariff policy would make the point that inflation still remains above the Fed's target, so you're threatening that price base by adding on more duties at a fairly sensitive time. The thing to remember is that this particular round of tariffs has been targeted at Mexico and Canada because of the fentanyl trade, because of immigration, illegal immigration. There had been a consideration that maybe the governments could come to an agreement on that. We haven't seen any prospect of that yet, and President Trump just then didn't hint at anything is likely near term. So we haven't yet got to the merchandise goods deficit part of this. That's the next part of this story. So by all indications are, providing these tariffs do go into effect on Tuesday morning, the indications are this could be the start of a very long, serious, protracted negotiation between the three governments.
We're currently seeing President Trump departing from the Joint Base Andrews as we continue to, of course, hear from President Trump and all of the tariffs that he's been talking about, especially when it comes to also cutting funding to South Africa and, of course, those tariffs that might be coming for Europe as well. And we are considering these as an opening tariff, gradual and targeted at the moment. Could they get worse? I mean, President Trump has talked about even 60% tariffs on China during the campaign trail.
You know, less targeted and less gradual, Shery. I mean, he's making a point pretty quickly in terms of the breadth of goods and the level, provided it goes ahead. But there's no question that when it comes to China, 10% as an opening gambit is a long way from the levels the president has spoken about in the past, during the campaign trail. And of course, we know that the president has been consistently hawkish when it comes to the merchandise goods trade deficit with China. So the expectations are there will be some kind of thorny negotiations coming down the road at some point. And then you just heard his remarks before getting on the helicopter that the European Union is in his sights. He's warned about that before, so they're going to be coming down the track. So, in terms of an opening gambit for trade disputes or a trade war with many key trading partners around the world, clearly we are at the early stages of that. It's hard to see how this would be solved easily, given the gulf of the problems between all of these countries, and of course the risk of retaliation as well. And from key trading partners, and the US themselves have promised that they will retaliate. There's a clause in the executive order that came out over the weekend that if Mexico and Canada retaliate against these US tariffs, the US will retaliate back against that. So you're in a tit for tat, and when you're in that kind of a cycle, it takes a long time to really, it's easy to start it, but it takes a long time to really unwind it. So, it's pretty hawkish, it's pretty serious messaging and decision-making from the new president. And I think all the signals are that there will be considerable focus on trade negotiations with key trading partners, I think, at least in the early to medium term of this administration.
And the tit for tat this time comes at a time when the Chinese economy is a whole lot more vulnerable than it was back in 2018, right? Do you see there being more limited, weapons that Beijing can reach for, even if perhaps that 10%, is a pretty gradual start to proceedings?
Yeah, the China story has changed a bit since the last trade war, because remember, the pandemic, of course, had a dramatic impact on supply chains, on perceptions in terms of doing business with China. Investment and production has shifted, or at least, hasn't gone to China whereas once it would have. And then, of course, you've had the Russian invasion of Ukraine, which has also put China into geopolitical crosshairs. So there is a bit of a different backstory to that, no doubt about it. And China, of course, on their side have diversified. I mean, they've been buying more farming produce from Brazil, for example, cutting their reliance on American farmers. But the president and people around him have, and in fact it's in the executive orders that they signed, have made the point that the initial trade deal with China hasn't necessarily been honoured. They're going to examine that and see, have China kept up with the purchasing promises that they made back then. So there's an April 1 deadline for that. So there will be expected to be more news on the China front. And China, you've got a strong US economy, you've got a weak China economy at the moment. Given the advantage to the US, a lot of observers would say, but China can respond in their own way. They can make it awkward for US companies to do business in China. They can make it awkward for US personnel to operate in China if they want to. And of course, they can trim or put whatever tariffs on trade to do with the US from their side as well. So there's a bit of two-way in it, but there's no doubt in terms of a headline look at this that starting out, the US is considered to have a bit of a stronger hand of cards in this when it comes to the expected trade dispute with China.
Bloomberg Global Economics correspondent Inda Karen there from Washington. We did have that reiteration of that policy position and some of the really threatening of imminent tariffs for the European Union as well. And we saw that immediate reaction really when it comes to European equity futures as well as trading in the euro and the pound. That reaction coming through the decline when it comes to Euro Stoxx 50 futures that we're seeing at the moment, that tumble of close to 3% at the moment. A range of currencies, the euro, the pound, including the Aussie dollar as well, go as more of a risk proxy in this part of the world are all sliding lower in response there. And it's interesting when it comes to that reaction in futures, we could see a pretty ugly open as we have seen in the cash session here in Asia. But of course, up until this point, we have seen European equities kind of trading almost with a sense of complacency, perhaps with this idea that, you know, even after the announcement of expected tariffs on Canada, Mexico and China, those ones on the EU that are now still expected haven't come to fruition yet. So that dodging of tariffs for now has been sustaining some sense of calm when it comes to European equities, but that looks like that may have come to an end in today's session, given the pretty ugly picture that we're seeing at the moment for Euro futures. Shery.
Yeah, we're taking a look at really an ugly picture across the board right now as we head towards a Taiwan and Hong Kong market opens as well. Of course, we had already seen Chinese stocks that could potentially take a hit, like online retailers, Alibaba, chip makers, companies with Mexico exposure. We know that the tariffs include a broadside against e-commerce with apparent plans to kill a tariff exemption for packages worth less than $800. So those are some of the names that we'll be watching when Hong Kong trading gets underway. Take a look at TAIEX futures at the moment. They actually rose before the close about 0.5%, but we'll see what that means for other stocks like TSMC, for example, that could be one of the biggest hit when the markets open. Semiconductor makers in focus. Let's bring in Bloomberg's Apisha Vishnoi and Winnie Su for more analysis on what to watch when trading gets underway in these two markets. Let's start with you, Apishek. Hong Kong markets coming back from Lunar New Year holidays. What are some of the sectors that you'll be watching?
I think the sectors that you mentioned are pretty much on the money. I mean, online retailers would be the first thing that comes to mind. Names like Alibaba, PDD is not listed in HK, but those and those companies in relationship with those online retailers would be one that might get impacted the most. That would be followed by chips. Now, on chip side, Asia ex China, we might see some kind of repricing lower down. I mean, Taiwan is also just opening up and just about to factor in DeepSeek's jolt. But on China side, if these tariffs actually fan nationalism again, fan that whole point about China becoming self-sufficient in industrials and technology, then SMIC and the likes of Huahong might actually do better. Apart from that, Mexican exposure of all kinds of companies listed in Asia would also be on radar. Names like BYD were looking to open a plant there. There are some chip makers also that were looking to open a plant there. Those investments now come into question. A lot of companies are earnings revenues based out of Mexico. China has a couple of auto companies as well, which have revenues coming from Mexico. So that exposure would also be under threat. And Trump has just started this trade war, and we have seen him promising tariffs from a whole gamut of sectors, right from pharmaceuticals to resources and whatnot. So, the entire trade war sort of premium or how markets were looking at it, that is getting priced in. So almost every sector would probably have sort of lower valuations to go ahead.
It's interesting, Abhishek, because with everything DeepSeek related last week, there's sort of one school of thought that maybe that development makes broader Chinese equities a bit more compelling.
Yeah, I mean, that's true. It does make Chinese equities compelling. But look, valuations so far have been factoring in that Trump would be a bit softer than what was generally expected in terms of tariffs, and probably Chinese valuations are cheap enough. But then, Trump has come in, followed up on his promise. He has been softer, but he has called in for 3 trade review reports by April 1. Now that just shows that he's looking for a lot more information to come on his desk before he actually decides what he has to do next. He has already employed a lot higher tariffs than what he had initially planned on Canada and Mexico. He's just beginning to negotiate with China. But it doesn't look like that this will become an upside trigger for China. It's a convoluted investment thesis. It's a thesis where China is cheap, but there are a lot of sectors at risk. So net, I think it's going to keep the valuations where they are.
And Winnie, of course, TSMC just escaped last week's sell-off because of DeepSeek, and they're coming back online today. And now we have these tariff threats as well.
Exactly, not the best start of the week after such a long holiday. But like you said, we had a very volatile week, and as we saw what happened to SK Hynix on Friday, down 10% after the Korean market reopened, that's kind of similar thing that we might be able to see today with TSMC and the Taiwanese stock market. The ADR's U.S.-listed stocks were down about 13% on Monday when that news hit, but now it kind of had already recouped some of the losses and now just down about 5% because of some of the more positive news around ASML, around Advantest, some of the earnings showing that the AI demand is still there. So we might see a hit on semiconductors, especially TSMC, because it reopened after the stock market closed for so long. However, hopefully we won't see such a big hit just due to some of the more positive news throughout the week.
I suppose the question is also how much upside we could potentially see, right? Are there any stocks that you're watching in particular that could get the more of a sort of beneficial impact?
Well, in terms of beneficial impact, I don't think there are many sectors that I'd be watching out for, but definitely heavens are getting a bit today, right? From currency markets to bonds, anywhere. So you have to start thinking in that context. And I was looking at our Morgan Stanley note, which was dated Feb 1, just when news flow on tariffs had started picking up, and that sort of reiterated the investment thesis that our reporters have also been writing about. That parts of ASEAN which have been benefiting from supply chain diversification from China, parts of India, some sectors in India which are reasonably priced, they are better off. That's where there would be less downside. But look, it is the first salvo in trade war, we have seen Canada retaliating. We have seen China promising to retaliate. So it's an eye for an eye kind of scenario right now. So net the valuation would be lower for most sectors. But yeah, traditional havens and the thesis about ASEAN and India benefiting from supply chain diversification, that still stands, and that's where probably some money might get parked in.
Bloomberg's Abhishek Vishwa there and Winnie Su ahead of what is likely to be a pretty interesting market open across Greater China. We do have more ahead on the Asia trade. This is Bloomberg. India has given middle-class consumers $11.5 billion in tax relief in its latest budget in a bid to shore up its economy amid growing global risks. Let's get across to Bloomberg's Haslinda Amin in Mumbai.
Well, Haidi, that budget over the weekend, some call it prudent, others say bold and even beautiful, providing the middle class tax relief amounting to about $12 billion, all in an effort to boost the economy, boost consumption. This is an economy that grew more than 8% at one time, now about 6%. It is risking derailing Modi's plan to have India a developed nation by 2047. Now, a lot is being said about how the economy needs a boost and that budget may just provide that. The question really is, how much of a boost will it provide? Well, let's get perspective insights from Shweta Rajani, head of mutual funds at Anand Rathi Wealth. Shweta, good to have you with us. This is a brand new studio. We're really excited to have you here as our first guest. First off, though, this budget was released at a time of macro environment uncertainty, and we just heard from Trump himself imposing tariffs on the likes of Canada, China, as well as Mexico. How do you see that playing out for India?
Sure. Good morning and congratulations on the news studio. So yes, we did have the budget at a time when there is global uncertainty as well as, little struggles on the domestic front as well. But actually, if you see specifically on the tariffs, now what we are seeing is on a relative basis, India could actually be a beneficiary of it because there's huge tariffs coming in on China. India has an advantage, so we could get a lot of that trade shifted from China to India. On the other hand, if there are tariffs imposed on India, that's the other risk. You see that could India be the next one over there? So from that perspective, if we see in just terms of the goods that are exported to US, rough math basically says it's less than 2% of the GDP that could get impacted. And India has an advantage also that you're looking at boosting the in domestic consumption. So that, if I have to weigh what could be the negatives of a tariff coming in and the increase in exports because China trade moving to India partially, as well as the domestic consumption giving a boost, I don't see so much of a downside risk to the Indian GDP from a tariff coming in. Of course, could there be an interim volatility? Yes, that we have to brace for.
Volatility will always be there. 2025 is going to be a year of vol. It is interesting when you take a look at how the U.S. is imposing tariffs. India, on the other hand, has been cutting tariffs, everything from autos to textiles. How do you see this playing out? I mean, on balance, how does it look for India? How does it then, how does it affect its competitiveness?
Absolutely. So, clearly there is this drive of Make in India, and which is where they've been boosting a lot of the manufacturing, bringing in a PLI schemes, reducing the tariffs here. So there would be an impact on the balance of payment because the trade deficit would widen a little. But today, over the last few years, we've got very comfortable with our trade deficits as well. There's, forex reserves, which is there. RBI has been very active in terms of ensuring that the rupee doesn't depreciate too much. So even, after where we are seeing the rupee being, it's still, on a relative basis, is well positioned compared to the other countries.
Let's talk about the rupee, though. It is hovering at record lows. We've seen the dollar rising for 6 days in a row. And with the tariffs, chances are the dollar will rise again. Where does that leave the rupee?
Yes. So over a longer time period, so if I exclude this few months, which could mean that, we see far more depreciation in the rupee as compared to the long-term averages, it should hover around 2.5–3% of depreciation over the next 1.5 year. That's the projection. And yes, there have been pockets even in past where you could have seen the rupee depreciating by around 5.5–6%. But then, we also have good amount of forex reserves. RBI has been intervening. And, with all those steps being taken by the government, by RBI, and where we are seeing the India positioned itself to be a stronger economy, it should get back to an average 3% of depreciation against the dollar.
So where do you see the rupee trading in 2025?
I would not be surprised if I see a 87, 88 level in the interim, and then it going back to that trajectory of a 2.5–3% depreciation.
Okay, let's talk about the budget now. We're talking about how, it's providing relief for the middle class, $12 billion worth. Yes. Yet, at the same time, we're looking at the government putting its deficit at 4.4%, hardly moving it. I mean, how do you square that?
So actually, I'll say the budget was very, very balanced in that way. There were no big bang measures announced, but very smartly, the government is also trying to revitalize the private sector. So, whatever it has to do, you see the capex targets just gone up by around 10%, but they're boosting a lot of PPP module. Consumption, on the other hand, is also likely to go up. Like you said, just to give you some numbers, 25% of the salaried individuals fall in that bracket of less than 24 lakhs, where they could get a huge tax advantage because of the rebate. So that would boost the disposable income, which means consumption going up, as well as it would have a benefit on a lot of the, therefore, sectors over here without compromising on too much of the infra play. Infrastructure, over the last few years, if you see, there's been a moderate 8 to 10% increase across how the infra is being played. So they're not missing out on infra, while it may look like there's not much increase in the capex. It's just more structural in terms of saying private, you have to now start kicking in.
Okay, so given that backdrop, how do you play? How does your portfolio, how should it look like?
Sure. In terms of sectoral allocations?
Yes, that's right.
Okay. Clearly, first is consumption. So, given the disposable income going up, a lot of policies announced in terms of footwear, toy, all those sectors, so consumption. Second, I would say auto. Auto again, because it will be a beneficiary of the disposable income going in. Plus, there were a lot of policies or custom duty cuts, exemptions announced for auto components, PLI schemes. So that's going to benefit that segment. Agri, there's a 17% increase in the budgetary allocation, and a lot of those schemes announced there, which could boost, your fertilizers, seed, all of those. Banking is not to be missed over here because there's a lot announced for MSME and credit enhancement for the struggling housing sector, infra bonds. So there are a lot of those benefits. So I think if I have to just top 3-4 sectors that should be there in a portfolio, I would say this is how it should look.
Shweta, thank you so much for joining us this morning. Shweta Rajani, Head of Mutual Funds at Anand Rathi Wealth. Shery, heading back to you. And of course, again, we're coming to you live from our new studio here in Mumbai.
Yeah, we'll be watching for the market opens in India, but right now we're seeing that downside pressure across Asia. We are seeing the Nikkei losing ground and the Kospi seeing its worst day since September of last year. Same for Kia Motors, that of course is exposed to a factory in Mexico. Kia is losing ground by the most since September as well. Other car makers are in focus, especially across Japan as well, as Nissan, the likes of Mazda, fall the most in about 6 months as well, given their exposure to Mexico. We are seeing the Japanese stock market lose ground for the first time in 4 sessions as well. We continue to watch those semiconductors, the likes of SK Hynix, Samsung, which is exposed to sales to China, also down. We have more ahead on the Asia Trade. This is Bloomberg. Take a look at some of the stocks that we'll be watching when the markets reopen in Hong Kong and Taiwan after the Lunar New Year holidays. We're watching TSMC, Hon Hai Precision in Taiwan, as well as SMIC and Hua Hong in Hong Kong. Of course, those markets reopening after the holidays, and they are now going to react to last week's AI shakeup triggered by China's DeepSeek as well. Not to mention, of course, the tariffs coming from President Trump. I mean, he has talked about taxing chips as well. Morgan Stanley now saying that Taiwan and Korea are the most exposed in terms of total revenue share from exports to the U.S. as well, Haidi.
Yeah, Taiwan, TSMC really in focus today. But take a look at what we're seeing. Really red and risk off across the board, from US futures to, of course, a pretty big reaction when it comes to European assets as well. Euro futures plunging by 3%, and 1 point was sort of off those session lows, but still that reaction being seen across a plethora of currencies, the pound, the euro, as well as that sort of China and risk proxy in the Aussie dollar as well. And certainly the euro has been in that downward trend already, right, given the stronger dollar. It fell every day in last week's session, as well as that sort of euro area data and the economic growth prospects, the bets on the ECB having a lot more cutting to do as well. And now the definitely will happen situation when it comes to tariffs on the EU are at play.